Steve Peterson here with Infinity Investments. Welcome to our channel, and in today's video, we're going to be talking about using commercial real estate as a hedge against inflation. How do you beat the street, if you will, using commercial real estate? Now, look, we're in hyperinflationary times. All right, every economic indicators pointing to that. Just go to the grocery store. You don't need CNBC or economic reports. Go to the grocery store, and you will understand that we are in hyperinflationary times. All right. So what do we do about this? First of all, don't panic. All right, periods of time like this have happened before in the past. What I've been doing is talking to a lot of people who I know who were doing business in the 70s. That was the last real serious period of hyperinflation, right? And so figuring out, what are some of the strategies? How do we navigate through this, right? So we can always look to the past to figure out how we navigate in the future. So me being in the commercial real estate business, loving commercial real estate, I think there's a few ways that you can use commercial real estate to be a hedge against this inflationary time. And what do we mean by hedge? When we're saying hedge, is basically minimizing your downside. And maybe there's some other ways of presenting that, but cutting off, hedging your bets. Like you're minimizing your losses, right? And so what we're saying, hey, here's a couple of great ways of you to be able to do that. And inflation is interesting because losses are different, right? With everything going up in terms of cost, you would think, property's going to go up. It should be great. But there's a lot of costs that are associated with running properties that could, cause you to take some losses probably, right? So what we're talking about when we're saying hedge, especially if you have a portfolio or you have capital to invest, is you need to be able to structure ways for you to minimize your downside risk. And commercial property done right, acquired the right way, can really be that hedge against these inflationary times and the losses that you may take as a result. All right. And number one thing I'm going to talk about is, do you know right now the average commercial real estate loan, whether that's apartments, retail, office, is less than the average single family home 30-year fixed? Now, we don't have a lot of 30-year fixed loans in commercial real estate. Most of them will be like 10-year. However, if you buy apartment buildings, which by the way is still commercial real estate, yes, there is 30-year fixed financing in some apartments, which is very rare, but I've seen it before. But the bottom line is the average rates in commercial are cheaper than residential. All right. And I've been in the business since 2003. I haven't seen that happen before. This is the first time. It may have happened before in the past. First time in my life that's happened. Right. So all things being the same, if we're out and we're looking at properties that can maybe generate a 7 to 8% cap rate, and we can go out and get 5.5 to 6% money, we are doing well. All right, we are doing well against the street, if you will, against these inflationary pressures. Right. What's interesting in the marketplace is that capitalization rates, have not risen as high and as fast as interest rates have risen. All right, so values are still holding, although they are dropping. They are coming down, and we expect cap rates to go higher, right? But knowing that our rates are actually more reasonable in commercial than in residential rates, right? Finding the right asset where you can get sub 6% debt right now could really bode well for you over the next 3 to 5 years. Now, another thing to consider is that many commercial loans are assumable. In fact, most of them are assumable, I would say, for a fee sometimes, and most of the times. But you can assume these loans. And we're talking right now originations in the 5%. And in fact, I sold a building earlier in 2022, July 2022, where that client got a high 4% on their interest rate on an apartment building, right? But do you know when we're talking about assuming loans, we're talking about loans that were done in the past. Loans that could have been done from 2019 to 2022, maybe. Loans that might be in the 3%, that are in the 3%, high 2%, maybe even low 4%, right? And so if you can come in and you can acquire a property that has a 3% loan, and I know 3 of them on the market right now in Oakland, right now. Listed properties, they're not hiding, they're out on the open, advertising. Come by me, I've got 3% debt that you can acquire. Buy this property, you assume the loan, now you're at 3%. The marketplace is at 5.5%, 6%. You are beating the street. That's a hedge, right? That's a way for you to minimize your downside. And while you're minimizing your downside, you're actually advancing your portfolio because the rest of the market is getting financing at 5, 5.5, 6, but you can assume a building in the 3s, maybe even the 2s. How about that? And now, when you run that building, yes, your water bill may be up. Your gas and electric bill may be up. Your maintenance cost is going to be up, right? We're in a rent control market. You may or may not be able to benefit from increased rents. Understand another thing. Things like Section 8. Section 8 is not subject to rent control. It's already a subsidy. So you can get increases on Section 8. Now you got to get them approved and all that. That's apartment buildings. Office buildings, retail spaces, they're not subject to rent control. Now, they may be harder to rent. You really need to figure out what areas you're going to be in. Some areas are obviously better than others in terms of office or retail space. But you know what's doing real well? Industrial. Industrial property right now. Rental rates high, values high, the buying activity's still there. Rents are higher there. But lenders love industrial property. So if you can get industrial property, lower interest rates than you could for a house, right? You got plenty of leasing activity. What's going on in internet shopping, what's going on like in our market with cannabis, what's going on with logistics, 3 major industries, right? Online shopping, logistics, cannabis in California. There's not enough quality warehouse and industrial space, right? And you can get some great financing on that. And so just giving you some ideas of how commercial real estate can help you to beat the street. I mean, you can go get financing at cheaper rates than you could. You can assume rates. You can assume loans that have very low interest rates. And then you can find properties like industrial properties and apartments that are in demand. The rents are in demand right now. They're in demand. All right. And the last piece I would talk to you about is purchasing distressed properties like maybe an office building, a hotel building, or retail, and repurposing them. Coming up with a different use, a better use, right, for that particular property. Finding what's in demand and bringing that to the marketplace. While we're in this kind of crazy time, you can do something like that, and now intrinsically create more value in that building, and then beat the street that way, right? And when we're talking about this inflationary period, look, I don't got all the answers, but what I'm trying to do for me, my company, my staff, my clients, my investors, my partners, is aggressively every single day looking to stay ahead, looking for ways that we can win during this time. Not just stay ahead, not just hedge, cover the downside, but actually win, right? Actually win. But you do need to figure out how you're gonna hedge and cover your downside in times like these, right? I remember in 2008 and 2009 when the market crashed, and a lot of people didn't know where the bottom was. And so the smart investors that were out there buying, what they were looking at is a couple of deals I was involved in. They're saying, hey, look, we don't know where the market's at. It may go down more. I am hedging my bet, so to speak, by buying rental property, apartments that I knew I could rent out. I knew I could make positive cash flow. And irregardless of what the market's doing, that this is going to be a great investment because it's cash flowing. It's in an area that's going to receive growth, maybe not now, over a period of time. So I'm not so concerned with the value drop. So their hedge against that risk of value drop was significant cash flow going in. And in those days, it was significant in the Bay Area, right? So you got to find a way to cover your downside, and you got to find a way to beat the street. And I just think that commercial properties done right, purchase the right way, purchase with the plan, purchase with the right financing, right? purchase with maybe an idea, we're gonna take it from this use to this use, can really not only hedge you against inflation, but can give you major victories and maybe push forward your portfolio, your business, your game plan to other levels of success. And if this video helps you, man, please like and subscribe for sure. But share this with someone. Share this with somebody, another like-minded individual in your network, because this is the type of stuff we need to be talking about, y'all. Comment if you got some ideas of how you can hedge inflation, right? Comment if you got some ideas how you can beat and benefit from what's going on. And let's keep this knowledge flow going on, and let's keep our heads up and our eyes open despite whatever the market conditions is. Let's be positive problem solvers. And into the next video. Peace.